investment is all about. Investment is putting out money to get more money back later on from the asset, and not by selling it to somebody else, but by what the asset itself will produce. If you're an investor, you're looking at what the asset is going to do, in our case businesses. If you're a speculator, you're primarily focusing on what the price of the object is going to do independent of the business, and that's not our game.
How the popular press tends to think of things, but we don't consider ourselves, Charlie and I don't, richer or poor based on what the stock does. We do feel richer or poor based on what the business does. So we look at the business as to how much we're worth, and we do not look at the stock price, because the stock price doesn't mean a thing to us. I mean, it doesn't for a variety of reasons, but beyond that, imagine trying to sell hundreds of thousands of shares at the stock price. We can always sell the business. We're not going to do it, but we could always sell it for what the business is worth. We can't sell our stock for necessarily what the stock price is. So we look at the business entirely as in terms of evaluating our net worth. We figure our net worth went up very, very slightly in 1999, and we would figure that no matter what the stock was selling for. It just doesn't make any difference, because we do look at the businesses. We really look at it as if there wasn't any quote on the stock, because we don't know what the stock is going to do. If the business gets worth more at a reasonable rate, the stock will follow over time, but it won't necessarily follow week by week or month by month or year by year. We had a lousy year in 1999, but the stock price did not calibrate with that in any perfect or close to perfect manner. And we've had good years other times when the stock price is way overpriced or over-described what happened during the year. So we really measure it all the time by the business. We think of it as a private business, basically, for which there's a quotation, and if it's handy to use that quotation, either in buying more stock or something of the sort, we may do it, but it does not govern our ideas of value. Charlie?
Yeah, generally I would say that if you have a lot of lovely wealth in a form that makes you comfortable.
I don't know, Charlie, I wouldn't blame business schools particularly for most of the ills, would you? I think they've taught the students a lot of nonsense about investments, but I don't think that's been the cause of great societal problems. What do you think?
No, but it was a considerable sin.
Well, you want to elaborate on what was the more sinful?
No, I think business school education's improving.
Is the implication from a low base, or?
Yes.
I'd agree with that. No, in investing, I would say that probably the silliest stuff that we've seen taught at major business schools probably has been, maybe it's because it's the area that we operate in, but has been in the investment area. I mean, it is astounding to me how the schools have focused on sort of one fad after another in finance theory, and it's usually been very mathematically based. When it's become very popular, it's almost impossible to resist if you hope to make progress in faculty advancement. Going against the revealed wisdom of your elders can be very dangerous to your career path at major business schools. And really investing is not that complicated. I would have a couple of courses. I would have a course on how to value a business, and I would have a course on how to think about markets. And I think if people grasp the basic principles in those two courses, that they would be far better off than if they were exposed to a lot of things like modern portfolio theory or option pricing. I mean, who needs option pricing, to be in an investment business? And that, when people, when Ray Kroc started McDonald's, I mean, he was not thinking about the option value of what the McDonald's stock might be or something. He was thinking about whether people buy hamburgers, and what would cause them to come in, and how to make those fries different than other people's, and that sort of thing. It's totally drifted away. The teaching of investments. I look at the books that are used sometimes, and there's really nothing in there about valuing businesses. And that's what investing is all about. If you buy businesses for less than they're worth, you're going to make money. And if you know the difference between the businesses that you can value and the ones that you can't value, which is key, you're going to make money. But they've tried to make it a lot more difficult, and of course that's what the high priests in any particular arena do. They have to convince the laity that the priests have to be listened to. Charlie?
If our activities were limited to marketable securities, and I had less than 100 partners, and we were operating with this kind of money, so that there was a real limitation on what we could do, I would simply tell the partners and let them make the decision. That would be easy enough. We're not in that position. We've got a number of wonderful businesses, and those businesses will grow in value, and in some cases very significantly in value. And it's not a feasible way. People have their own way if they decide that since we're unable to find things, that they'd rather go on to something else. They have their own way of getting out, and they can get out at certainly a premium to the amount of money they put into the business over the years. So if I were running a marketable securities portfolio now, and we're limited to that, I would explain very carefully to my partners how limited my ability to make money in this market would be, and then I would ask them to do whatever they wish to do. Some of them might want to pull out, and others might want to stay. In the 1969 period when I closed up, I had a somewhat similar situation in terms of finding things, and B, I really felt that the expectations of people had been so raised by the experience we'd had over the previous 13 years that it made me very uncomfortable, and I felt unable to dampen those expectations. And I really just I didn't find it comfortable to operate where my partners, even though they might nod their heads understandingly and say that, we really know why you aren't making any money while everybody else is. I didn't think I wanted to face the internal pressure that would come from that. I don't feel any such internal pressure in running Berkshire. Charlie?
Yeah, I think there are some similarities between 1969 and 70 and the present time, but I don't think that means that 1973-4 lies right ahead of us. We can't predict that. You can argue it worked out wonderfully for Warren to quit in 69 and then have 73-4 to come into with his powder dry. I don't think we're likely to be quite that fortunate again.
Yeah, it was a long time from 69 though to 73. I mean, it sounds easy looking back, but the Nifty 50, as you may remember, sort of hit their peak in 72. So although there was a sinking spell for a while in that 69-70 period, the market came back very strong. But that's part of the game. I mean, it stayed cheap a long time from the 73 period on, and you will find waves of optimism and pessimism, and they'll never be exactly like they were before, but they will come in some form or other. But that does not mean we're sitting around with a bunch of cash because we expect stocks to go down, though. We keep looking for things. We're looking for things right now. We're talking to people right now about things that where we could expend substantial sums of money, but it's much more difficult in this period. Zone 12.
The main thing that they can't mandate in annual reports, I really like to have. I like to know as much as I can about the person that's running it and how they think about the business and what's really going on in the business. In other words, I would like to have a report that would be identical to what if I owned half of a company but was away for a year and I had a partner who owned the other half. When I came back, that he would
tell me about what had taken place during the past year and what he foresaw coming up and all of that. That is what I think the purpose of the report is. Now, the SEC mandates a lot of information, and some of that is helpful, but there's an intent behind the report. I mean, if it's a sales document, I'm less interested. I don't see any way to mandate what I'm talking about, but that's the kind of report I'm looking for. What I'm trying to do as I read reports, I like to understand just generally what's going on in all kinds of businesses. If we own stock in a company, in an industry, and there are 8 other companies that are in the same industry, I want to own or be on the mailing list for the reports for the other 8, because I can't understand how my company is doing unless I understand what the other 8 are doing. I want to have the perspective of, in terms of market share or what's going on in the business or their margins or the trend of margins or all kinds of things that I can't get unless I know. I can't be an intelligent owner of a business unless I know what all the other businesses in that industry are doing. And so I try to get that information out of a report. If I'm thinking about investing in a specific company, I try to size up their business and the people that are running it. And over the years, I found reading a lot of reports to be quite useful in terms of making business decisions at Berkshire. If we own a whole of a business, I want to own shares in all of the competitors just to keep track of what's going on, and I want to be able to intelligently evaluate how our managers are doing that, and I can't do that unless I know the industry backdrop against which they're working. It's amazing, how well you can do in investing really with what I would call outside information. I find inside information, I'm not sure how useful that is, but outside information, there's all kinds of information around as to businesses, and you don't have to understand all of them. You just have to understand the ones that you're thinking about getting in, and you can do it if you just. But nobody will do it for you. You can't read. In my view, you can't read Wall Street reports and get anything out of them. You have to do it yourself and get your arms around it. I don't think we've ever gotten an idea, in 40 years from a Wall Street report, but we've gotten a lot of ideas from annual reports. Charlie?
What I find is that it takes a long time to read the annual report, even if it's a comparatively simple business. As if you really are trying to understand it, it's not a bit easy.
Yeah, I would say that on average in a business we're really interested in, even though we know what to skip to some extent, what to read. I mean, it's going to be 45 minutes or an hour on a report, and if there are 6 or 8 companies in the industry, that's going to be 6 or 8 hours perhaps, and then there are quarterlies and a lot of other. I mean, the way you learn about businesses is by absorbing information about them, thinking it, deciding what counts and what doesn't count, relating one thing to another, and that's the job. And you can't get that by looking at a bunch of little numbers on a chart bobbing up and down about or reading market commentary and periodicals or anything of the sort. That just won't do it. You've got to understand the businesses. That's where it all begins and ends. Zone 5. I don't remember the exact wording of that article, but I'm quite sure that I told the author of that article, and I'm almost positive it was in the article, that I said I thought it was more attractive than owning the general market or the S&P. So I was saying that I preferred it to the general market. I'm certainly happy having 99 and a large fraction % of my net worth in it. I've never sold a share. I am not the least bit uncomfortable about holding it until the day I die, and quite a bit thereafter. But I have not thought stocks were cheap at all for some time, and I've never wanted to encourage anybody, particularly in the last few years, to buy Berkshire or any other stock, because the market, I felt that I felt we had a great bubble, and I think Berkshire's value has improved. I think Charlie does too, fairly significantly in recent years. And I would, if I had a chance to swap tax-free my Berkshire for the S&P 500 or for any mutual fund or anything. I wouldn't give it a thought. But that does not mean I think, either Berkshire or stocks are cheap. Charlie?
I've got nothing to add to that.
I don't think we've ever recommended the purchase or sale of Berkshire that I can remember. We did say at one time we would repurchase shares, which has a certain underlying message to it. And we said at other times we wouldn't buy shares. That doesn't mean we'd sell shares at all, but we wouldn't have bought them under the prevailing conditions. But we've stayed away from recommending actually not only the purchase or sale, not only of Berkshire, but just of any other specific shares. We've only given our views occasionally on what we think about the level of the stock market generally. But I do think if you go back and look at that article, I wish I had it here, but I think you'll find that I said I preferred it to equities generally.
I do think that there's a lot to be said for developing a temperament that can own securities without fretting. I think that the fretful disposition is it's an enemy of long-term performance.
Well, I think it's almost impossible if you're to do well in equities over a period of time. If you go to bed every night thinking about the price of them, I mean, Charlie and we think about the value of them, but we would be happy, just as in that movie, if they closed the stock exchange tomorrow. Dick Grasso wouldn't be happy, and Jimmy McGuire, our specialist, wouldn't be happy. It wouldn't bother me and Charlie at all. We would keep selling bricks, selling dilly bars, selling candy, writing insurance. A lot of people have private companies and they never get a quote on them. We bought See's Candy in 1972. We haven't had a quote on it since. Does that make us wonder about how we're doing with See's Candy? No, we looked at the company results. So there's nothing wrong with focusing on company results. Focusing on the price of a stock is dynamite, because it really means that you think that the stock market knows more than you do. Now, the stock market may know more than you do, but then you shouldn't be in stocks. I mean, you should have the stock market is there to serve you and not to instruct you. So you need to formulate your ideas on price and value. And if the price gets cheaper and you have funds, logically you should buy more. And we do that all the time. Where we make our mistakes, frankly, is where we focus on price and value and we start buying and the price goes up a little and we quit. Like Charlie referred to, we might have done on See's Candy. A mistake like that cost us $8 billion in the case of Walmart stock a few years ago because it went up in price. And we are not happy when things we're buying go up in price. We want them to go down and down and down, and we'll keep buying more. And hopefully we won't run out of money. Of course, that's a different story. Charlie, number 4. I grew up in a household, and my sisters are here, where gold was talked about frequently. So I've been exposed to a lot of thinking on that over the years. I don't really think gold has the price of gold, I should say, has anything really to do with the valuation of businesses. It may reflect certain things that are going on in prices attached to those businesses at given times, but I would not regard the price of gold does not enter into my thinking in any way, shape, or form in terms of how I value a business today, a year ago, 10 years ago, or tomorrow. When we look at Larson Jewels, the custom picture frame operation, I'm not thinking of that and relating it in any way to what gold has done. So it's just not a factor with us any more than other commodities would be. I mean, whether it's wheat, whether it's cocoa beans or whatever, it has a certain hold on some people, and but we don't look at it as an interesting investment, and we don't look at it as a yardstick for valuing other investments. Charlie?
Yeah, Warren is right when he says that interest rates are very important in determining the value of stocks generally. And I think he's also right when he says gold is very unimportant.
The second part of the question?
Thank you very much.
Except under unusual circumstances, my expected rate, my expectancy on something like bonds is what bonds are producing at a given time. I don't think I'm smarter than the bond market. Now you can say when those rates swing all over, does that mean I swing all over? The answer is pretty close to yes. I mean, I don't know what the right rate for bonds is. I think that if there's, I'm very leery of economic correlations. I mean, I spent years fooling around with that sort of thing, and I mean, I correlated stock prices with everything in the world, and the problem was when I found a correlation. I mean, it's you've seen these things on whether the AFC or the NFL wins the Super Bowl and all of that sort of thing. You can find something that correlates with something else, but in the end, a business or any economic asset is going to be worth what it produces in the way of cash over its lifetime. And if you own an oil field, if you own a farm, if you own an apartment house, with the oil field, it's the life of the oil field and what you can get out of it. And maybe you get secondary recovery, maybe you get tertiary recovery, but whatever it may be, it's worth the discounted value of the oil that's going to come out. And then you have to make an estimate as to volume and as to price. With a farm, you make an estimate as to crop yield and costs and crop prices. And the apartment house, you make an estimate as to rentals and operating expenses and how long it'll last and when people will build other new apartment houses that potential renters in the future will find preferable and so on. But all investment is laying out some money now to get more money back in the future. Now there's two ways of looking at getting the money back. One is from what the asset itself will produce. That's investment. One is from what somebody else will pay you for it later on, irrespective of what the asset produces, and I call that speculation. So if you are looking to the asset itself, you don't care about the quote because the asset is going to produce the money for you. And that's what society as a whole is going to get from investing in that asset. Then there's the other way of looking at it is what somebody will pay you tomorrow for it, even if it's valueless. And that's speculation. And of course, society gets nothing out of that eventually, but one group profits at the expense of another. And of course, you had that operate in a huge way in the bubble of a few years ago. You had all kinds of things that were going to produce nothing, but where you had great amounts of wealth transfer in the short term. As investments, they were a disaster. As means of wealth transfer, they were terrific for certain people, and they were for the other people that were on the other side of the wealth transfer. They were disasters. We look solely. We don't care whether something's quoted because we don't buy it with the idea of selling it to somebody. We look at what the business itself will produce. We bought See's Candy in 1972. The success of that has been because of the cash it's produced subsequently. It's not based on the fact I call up somebody at a brokerage house every day and say, what's my See's Candy stock worth? And that is our approach to anything. On interest rates, I'm no good. I bought some REITs a couple of years ago because I thought they were undervalued. Why did I think they were undervalued? Because I thought they could produce 11 or 12% in terms of the assets that those companies had, and I thought an 11 or 12% return was attractive. Now the REITs are selling at higher prices, and they're not as attractive as they were then. But you just look at every asset class, every business, every farm, every REIT, whatever it may be, and say, what is this thing likely to produce over time? And that's what it's worth. It may sell at vastly different prices from time to time, but that just means one person is profiting against another, and that's not our game.